Welcome to Net Worth Newbies. Today, we're diving into the fascinating world of the stock market, specifically designed for beginners. If you've ever wondered how the stock market works or why it matters, you're in the right place. In this video, we'll break down the basics of stock trading, explain key concepts like stocks, dividends, and market indices, and help you understand how these elements come together to create a dynamic financial landscape. Understanding the stock market is crucial for anyone looking to grow their wealth or secure their financial future. It's not just for Wall Street professionals. Everyday people can benefit from investing in stocks. By the end of this video, you'll have a clearer picture of how to navigate this complex system and make informed decisions. So, whether you're looking to invest for the first time or just curious about how it all works, stick around. We promise to keep it engaging and informative, making sure you feel confident as you take your first steps into the world of investing. Let's get started. What is the stock market? The stock market is a platform where investors can buy and sell shares of publicly traded companies. When you purchase a share, you essentially own a small piece of that company, allowing you to benefit from its growth and success. The primary purpose of the stock market is to facilitate the exchange of these shares, providing liquidity for investors and enabling companies to raise capital. When businesses want to expand or develop new products, they often turn to the stock market to raise funds. By issuing shares, companies can attract investment from the public, which helps them finance their operations and growth initiatives. This process not only benefits the companies, but also provides investors with opportunities to earn returns on their investments. Moreover, the stock market plays a crucial role in economic growth. It encourages investment by allowing individuals and institutions to put their money into businesses that show potential for success. As companies grow and thrive, they create jobs, drive innovation, and contribute to overall economic development. In this way, the stock market serves as a vital engine for both individual wealth. How stocks work. Stocks represent ownership shares in a company, allowing investors to claim a portion of the company's assets and earnings. When you buy a stock, you become a shareholder, which means you have a stake in the company's performance. There are two main types of stocks, common and preferred. Common stocks give shareholders voting rights and the potential for dividends, which are payments made from the company's profits. Preferred stocks, on the other hand, typically do not offer voting rights, but provide fixed dividends and have priority over common stocks in the event of liquidation. Stock prices are determined by the forces of supply and demand in the market. When more investors want to buy a stock than sell it, the price tends to rise. Conversely, if more people are looking to sell a stock than buy it, the price will usually fall. Various factors influence these dynamics, including company performance, economic conditions, and investor sentiment. Understanding how stocks function and how their prices fluctuate is essential for anyone looking to invest wisely in the stock market. Types of stock markets. When it comes to investing, understanding the different types of stock markets is essential. The stock market can be broadly divided into two main categories: primary and secondary markets. The primary market is where new stocks are issued for the first time through initial public offerings, IPOs. This is where companies raise capital by selling shares directly to investors. Once these shares are sold, they move to the secondary market, where existing shares are traded among investors. This market provides liquidity, allowing shareholders to buy and sell stocks freely. Major stock exchanges play a significant role in the secondary market. The New York Stock Exchange, NYSE, and NASDAQ are two of the largest and most well-known exchanges in the world. The NYSE operates as an auction market, while NASDAQ is a dealer market, relying on a network of computers to facilitate trades. Additionally, there are over-the-counter OTC markets where stocks not listed on major exchanges are traded. Over-the-counter markets provide opportunities for smaller companies to access capital and for investors to explore a wider range of investment options. Understanding these different markets can help you navigate the stock trading landscape more effectively. How to invest in stocks. If you're ready to start investing in stocks, it's essential to approach it with a clear plan. First, set your investment goals. Are you looking to save for retirement, a major purchase, or simply grow your wealth? Defining your objectives will help guide your investment strategy and determine your risk tolerance. Next, you'll need to choose a brokerage account. There are many options available, including traditional brokerages and online platforms. Look for a brokerage that aligns with your needs, whether that's low fees, user-friendly tools, or educational resources. Some platforms even offer demo accounts, allowing you to practice trading without risking real money. Before making any investments, research and analysis are crucial. Take the time to understand the companies you're interested in, their financial health, and market trends. Look at factors like earnings reports, industry performance, and economic indicators. This due diligence will help you make informed decisions and minimize risks. By setting clear goals, selecting the right brokerage, and conducting thorough research, you'll be well on your way to becoming a confident stock investor. Happy investing. Understanding stock prices. Stock prices are not static. They fluctuate based on a variety of factors that can influence investor perception and market dynamics. One of the primary drivers of stock prices is earnings reports. When a company releases its quarterly or annual earnings, positive results can lead to a surge in stock prices, while disappointing earnings may cause a decline. Additionally, news events, such as changes in management, product launches, or economic indicators, can significantly impact stock valuations. Market sentiment plays a crucial role in how stock prices move. This refers to the overall attitude of investors toward a particular stock or the market as a whole. Positive sentiment can drive prices up, while negative sentiment can lead to sell-offs. Understanding investor behavior, including fear and greed, is essential for predicting price movements. To analyze stock prices effectively, investors often use two main techniques: technical analysis and fundamental analysis. Technical analysis focuses on price patterns and trading volumes to forecast future movements, while fundamental analysis examines a company's financial health, including earnings, revenue, and market position. By combining these approaches, investors can make more informed decisions about when to buy or sell stocks. Risks and rewards of stock investing. Investing in stocks comes with a unique balance of risks and rewards that every investor should understand. The concept of risk versus reward is fundamental in investing. Generally, higher potential returns are associated with higher risks. This means that while stocks can offer significant gains, they also carry the possibility of losses. Common risks include market volatility, where stock prices can fluctuate dramatically due to economic changes, geopolitical events, or shifts in investor sentiment. Additionally, the performance of individual companies can impact stock prices. Factors such as poor earnings reports, management changes, or industry disruptions can lead to declines in stock value. Despite these risks, stock investing has the potential for substantial long-term gains. Historically, the stock market has outperformed other investment vehicles such as bonds or savings accounts over extended periods. By holding on to investments through market ups and downs, investors can benefit from compounding returns and capital appreciation. Understanding the risks and rewards associated with stock investing is crucial for making informed decisions and developing a strategy that aligns with your financial goals. With careful planning and research, you can navigate the stock market effectively. As you embark on your investment journey, remember that knowledge is power. If you found this video helpful, please consider subscribing to our channel and liking the video to stay updated on future content. We invite you to explore related videos and resources on our channel or website to deepen your understanding of the stock market. Thank you for watching, and happy investing!